Hello, my name is Steve Farrington. I'm the Unemployed Value Degen. I'm not giving financial advice. Today I'm going to talk about options, so even more than just not giving financial advice. Options are dangerous, and you're probably better off if you don't do it. I usually try to start every weekly YouTube video now with a little bit of a macro peek. And for the last couple of months, been watching this 10-year Treasury, and finally, with the announcement of Scott Bessent as the new Secretary of Treasury nominee, the 10-year Treasury finally had some relief. Let me go out to the 5-year and zoom that out, and my prediction is that market participants believe that we are in this sort of a downward channel that looks something like that. And I don't know how long that downward channel is going to last, but if the 10-year Treasury stays zigzagging in this downward channel, for one thing, is just for the next couple of months, we're looking at falling interest rates, which are usually pretty good for the stock market. But more than that, that gives us a chance of getting to a 3-year 10-year Treasury, or a 3% 10-year Treasury. A 3% 10-year Treasury could mean that we could have a 5 to a 5.5% 30-year mortgage. And I think at a 5 to 5.5% 30-year mortgage, there's so much pent-up home equity that the economy would just explode as people start doing some home equity loans, some home equity lines of credit, going out and buying some jet skis and some ski boats and some Winnebagos and some Harley Davidsons. I think the economic activity, if we actually hit this 3% 10-year Treasury, leading to a 5 to 5.5% 30-year mortgage, would just be a shocking amount of economic activity. We might not get there. So I'm watching this chart for, is the pattern going to reverse, right? And I think a huge chunk of the financial markets are watching this downward trend. And the first time that the 10-year Treasury breaks out of this pattern to the upside, and that might surprise a lot of people, because, for example, we've been above 4.25% before, but if we're above 4.25%, say in the middle of the summer next year, well, that's not what people are expecting. So if the 10-year Treasury breaks out of this downward channel, I think some people are going to be pretty surprised, and that could cause a pretty good sized sell-off in the market. Now the Treasury rates, the 10-year Treasury rates, are heavily connected to the strength of the dollar. And the dollar index, it also peaked recently and started falling and giving a little bit of relief. Go ahead and put this channel. Now, let's see, if I started about here, I think this is about the channel we've been in for the US dollar. And I put out a trade alert on my Substack a couple of weeks ago now, saying that it's a good time to just buy something international, because if we're going to have a few months of a weakening dollar just on that trend, then even if over the longer term we do break out of this channel, we might have a strong dollar under the Trump presidency. I don't know. I don't think anybody knows right now. But if we have a weakening dollar just for a couple of months, then at least in a short-term swing trade, anything international should do well. Because you might have seen some news reports that the U.S. stock market is just dominating the world. We're taking enormous fund flows from the rest of the world, and people are buying U.S. stocks. And part of the reason for that is, you know, we have the Magnificent Seven, we have big tech, we have, or you know, clean a shirt in the dirty laundry hamper for rule of law. And now there's this euphoria under Trump that Trump is going to be pro-stock market. Maybe we'll have lowered corporate income taxes. Maybe we'll have accelerated depreciation. And somebody on Twitter posted this. I thought it was pretty interesting. They overlaid what happened to the dollar index in 2016 with Trump's election victory and then inauguration versus what's happening currently. And for now, it's overlapping. And these things are, I think they're more fun than serious, But what was really interesting about this was I had forgotten, in January of 2017, Trump tweeted that the dollar was too strong, and then from that the dollar sold off, pretty strongly, because in his first term Trump was very mercantilist. He wanted more exports to accelerate the economy. I don't know if that's going to be the strategy this time around, but it very well might be. But so we'll have to see. I don't necessarily think this pattern is going to hold. I just think it's more interesting to look at. That this predicts the dollar might rise a little more and then fall. I think we might already be in the part where the dollar is falling, but if it doesn't, so I think I would be looking for possibly some sort of a market correction or a sell-off in equities if the dollar broke out of this channel to the upside and stayed there. And I think we were there in the middle of November, and the market was struggling at that time. When we were at this peak so it was the 17th of November, we were at the peak in 10-year treasuries and the peak of the dollar index, because they moved together. The market was struggling then. So if I go to the S&P 500, where's 1117? Yeah, that's where the S&P 500 was giving back some gains, and we had a little retracement down to the 20-day moving average. So yeah, if we break out of this downward channel to the upside, or if we break out of this sideways channel to the upside, that could put some pressure on the stock market. The fear and greed index. So we were in greed last week, pretty solidly in greed, and we've fallen back to neutral, which is kind of funny because during that time, the S&P 500 has been rallying and pushing up against the top end of its Bollinger Band. So the S&P 500 has been rallying, and we've been getting out of the greed part of the fear and greed index. So it's an interesting time in the market. I usually look at this just for the components, because the put-call ratio, I like to sell puts for income, and it's not a good time to be doing that, right? Their puts are not fetching a huge price, and the VIX is super low, so options generally are not fetching a huge price. People aren't buying a lot of options right now, but the options they are buying are calls. So let's look at some of the indices. The S&P 500, and now we're in the middle of the Trump euphoria, the Santa Claus rally, the momentum chase, professional managers that have been underperforming. They need to try and squeak out some gains and save their careers toward the end of the year. But we're also in tax loss harvesting time. Last week, this is the equal weighted index. Last week, the equal weighted index underperformed and it fell. The week before that, 2 weeks ago, the equal weighted index had this huge rally. So 2 weeks ago, the S&P 493 had a huge catch up, and they just gave it back because, look at the NASDAQ. 2 weeks ago, the NASDAQ was struggling, and then last week it just broke out to the upside. So the NASDAQ is strong again. I've been waiting for this rotation out of big tech and into everything else, and it looked like we were getting that. It looked like the equal weight S&P had been outperforming the S&P 500. Right, the S&P 500 was struggling while the equal weight S&P 500 was rallying, and then last week it was a trend reversal. So I think right now nobody knows what's trend and what's counter trend, especially coming into the end of the year with tax loss harvesting, and then January to have portfolio readjustments and reallocations. So this is a exciting time to keep an eye on things, because nobody knows anything about what's happening. Is the Mag 7 now, was last week on trend or was last week counter trend? And you can really see it in the small caps in the Russell 2000, where 2 weeks ago we had this huge rally, and then last week we started giving that back. So it's a great time to pay attention to stuff. Now, getting out of the markets generally, and the reason for today's video, my first video on options was what I typically do is I sell puts to raise a little bit of income, and I like to do it on the very short end. I like to do it for a couple of weeks. But those gains, they're all short-term capital gains, which is taxed in the US as ordinary income. And that's painful, right? That's your highest marginal tax rate. Coming into Christmas, there's this opportunity once a year, because a lot of stocks have options, a market made for January of the next year. So you could sell an option today, collect that premium, and if that option matures in January of 2026, then that's going to be more than a 1-year hold period, which means you could have a long-term capital gain. And long-term capital gains, if you're in a high marginal income tax bracket, you'd much rather get taxed on your long-term capital gains. So another aspect of this is, let me just go back to the SPY, the S&P 500. This is 1 year. Let me go to 5 years. So the last 2 years, from the start of 2023, the bottom for this recent bear market was in the fall of 22. But starting in 2023, what is this? S&P 500 370, and now we're at 607. We've had more than 20% gains 2 years in a row. And a lot of people are looking at that saying, okay, well, we're not going to have 20% next year. Now, I'm not making a prediction. I'm just saying what the sentiment is generally on the street. And there's a lot of people saying, oh, well, that means next year we have to have a pullback. If you, so two things. One is the average length of time between 10% pullbacks in the stock market is about 350 days. And I think we're already past that. So we're overdue for a 10% pullback. And at the same time, after two 20% plus years in a row, on average, the year after that is positive on average, but not in a huge way. So a lot of people are saying, well, look, if best case, I'm looking at a 7 to 8% year in the S&P 500, and then worst case, I could have this big drawdown or a bear market, then what am I doing? Staying in the S&P 500. People had 2 years of 20% gains in the S&P 500, so now they're saying, well, now what? Well, this time right around Christmas, when you have a full 12 months and a little bit extra to get to long-term capital gain status for options that you sell, gives you a pretty good possibility, especially if you're predicting that the markets feel a little toppy. And I'm not making a prediction one way or the other, but a lot of people out there are saying this market feels a little bit toppy. I've listened to a lot of smart people that think we're still going to grind higher. But I haven't heard that many people think we're going to grind higher more than 20% next year. So, and I've talked about selling puts. Today I want to talk about selling calls. And just for example, pick a company like Microsoft. Now I'm a small cap value degen, so Microsoft's not my cup of tea. But you go back on this chart for a few years. Let me go weekly. So that's, back to this 23 fall of 22 low. This chart, it looks like it could roll over. This Microsoft, it could end up being weak next year. So if you're in Microsoft and it might be weak next year, well, and you've just been accustomed to having huge gains as Microsoft went from 225 to 443 over the course of 2 years. Say, well, it's due to give a little back or to stay flat. It could also grind higher. When you have a full year to go between now and then, you could sell a covered call at this January 2026 strike price or expiration date. And last time I talked about selling puts, which is selling the right to sell. A call is the right to buy. If you buy the call, you have the right to buy. People that buy calls are buying lottery tickets. They might expire worthless or they might end up really valuable. People that sell calls, they're selling volatility, but they're taking some money off the table. So if you have Microsoft in your account, or you want to buy 100 shares of Microsoft at this price, but you feel like it's a little toppy and the price might fall, to January of 2026, if you sell a call, and selling a call alone is dangerous, but there's a much less risky strategy, which is called selling a covered call. Selling a covered call is if you already own 100 shares of Microsoft. Now that's a tall order for most of us because 100 shares of Microsoft is $44,000. But if you owned 100 shares of Microsoft and you sold a call against it, the person who bought that call, they have the right to buy your shares from you anytime they choose between now and January 16th next year. But you get the cash up front. And in a world where you think maybe next year the price of Microsoft might fall, maybe next year the price of Microsoft might stay flat, well, it's not really so scary to say to sell to somebody else the right to buy your Microsoft from you. And you don't have to do it right at the money either. You can do it a little bit out of the money. You could look at this chart. We'll put up the Microsoft chart. And I'll go out to 1 year. And you say, you know what? I don't think Microsoft's going to break above this past peak at 465. Well, let's see what somebody would pay you for a call at 465. Well, somebody paid $45.55 a share for that call. Well, that's more than 10%. $45.55 divided by the current price, $443.57. Somebody's willing to pay you 10%. Is it 10.2% for the right to buy your Microsoft at 465. So if you think over the course of 2025 up until January 16th, 2026, that Microsoft is not going to be able to break out of this past peak, that Microsoft, it might be up a little bit, it might be up a tiny bit, it might be down, it might be flat. You could get paid 10% to sell to somebody else the right to buy your Microsoft at 465. And in a year where even market participants that are bullish think that the S&P 500 might go up 7 to 10%, well, you could take 10% cash off the table immediately. And, how could this burn you? How could things go wrong? Well, one thing is you could buy Microsoft and the price could go down, right? Microsoft could crash to $300 a share. And that could happen to anybody. But if you believe that Microsoft's a good company, you don't mind owning it for a long time, anybody who buys Microsoft can have that happen to them. The stock price can fall and they feel like an idiot. Well, if it's a good company, the price will rebound eventually, even if that's, hopefully not like the Japanese stock market from the 1990s, but hopefully eventually it's a little bit faster. The other way it could make you feel stupid and burn you is if Microsoft really did rally another 20% next year. So if Microsoft broke past $465 a share and say it went up to $500 a share. Well, if that happened and the other person who bought this call, they could go ahead and buy your Microsoft from you at $465. Now you don't have Microsoft in your account anymore. What you have in your account is $46,500 plus the $4,500 you got when you sold the option initially. So, they did buy your Microsoft away from you, but you had a pretty healthy return for 2025. It's hard to think that that's really a mistake. Although my biggest mistake has come from selling covered calls. I had done my due diligence. I'd done my analysis on Carvana. I knew that they weren't going to go bankrupt. I really liked Ernie Garcia. I thought he was, 180 IQ, that he was a great problem solver. He was going to get his way out of it. They had $2 billion of unencumbered land from an acquisition, and I knew that any bank would give them, asset-based financing. All of their debt was, unsecured. So any bank would do a senior collateralized loan on that $2 billion worth of land. So they had 4 or 5 years of runway. The company was not in any trouble. And so I bought 4,000 shares of Carvana at $3.92 a share. And then I sold calls at $5. And 4,000 shares of Carvana, that's kind of a life-changing mistake. And I wasn't really thinking through my transactions thoroughly at that time. I had a day job. I was kind of focusing mostly on my day job before I became the Unemployed Value Degen. But that's over a $500,000 mistake. Because I had done the analysis, I had the confidence to buy 4,000 shares of Carvana at $3.92 a share. but then I sold calls at $5. So on something that can have an explosive upside, you could really have a huge, psychological loss. You do the wrong thing and really miss out on gains that could have been, because you are limiting your upside. That's probably the worst case scenario in covered calls. Other than that, you buy a stock and the price goes down. That can happen to anybody, whether you sell the covered calls or not. Selling uncovered calls, selling a call where you don't own the stock, just don't do it. It's too dangerous. It's picking up nickels in front of a steamroller. There's better ways to short a security. The people that do that professionally, they know what they're doing. They size their positions well. They're watching it every minute of the day. They have stop losses. That's for professionals. It's not for amateurs, not for anybody watching my YouTube channel. Just don't do it. It's dangerous. Well, I wanted to look through of some of the positions that I've written about on my Substack and say, what does the yield look like? If 2025, those things are going to go sideways, they're going to have an explosive year, is it worth selling a covered call on those things? I could look at something like, what does New Fortress Energy look like? Now this one, this one I would not sell a covered call on. This chart, where it looks like to me that it's clearly started to break out, right? It was hovering around this $8, $9 area. They have improving EBITDA, and it's clearly breaking out. This is not really a time to sell a covered call on it. But one thing that's interesting is if you look at what people are paying for these things, it gives you an indication of how many gamblers are buying these lottery tickets. You kind of get a feeling of, is the crowd confident that the price is going to go up? So they're interesting to look at even if you don't want to do it. Going out to January of 2026 on New Fortress Energy, it's not super helpful because the options are so far outside of where the current price is. It's more efficient if the strike price is close to the current share price. But even looking out at $15, so the right to buy your New Fortress Energy at $15, people are paying $3.30 for that. Now, just on a yield, right? If you were to buy New Fortress Energy for $12.41 and you get paid $3.30, that's a 26.5% return. So if you, and again, I think New Fortress Energy, I think the price could have a huge recovery in 2025. So I don't want to sell this option. But if you've been accustomed to getting 20% returns for 2023 and 2024, if you bought New Fortress Energy, you got paid immediately $3.30 to sell to somebody else the right to buy that stock from you at $15. You've locked in a 26.5% cash yield for 2025. Now, how could it burn against you? How could it go against you? You could buy New Fortress Energy and the price could fall. But I mean, I've done my fundamental analysis on this one. I think it's a fantastic company. I think price falls would be temporary. I think the price is going to revert to, a much more reasonable valuation for the company. But you could buy any stock and the price could fall. So that can happen to anybody. And then the other way it could burn against you is, you buy this thing, the price goes to $20, and then somebody buys it from you at $15 where you've sold that call. But like I said, if you've been accustomed to taking a 20% gains in 2023 and 2024, you could do that this way, get 26.5% in cash, and it would be a long-term capital gain because you've got more than 12 months between now and January of 2026. So, should we sell a covered call for Christmas? That's New Fortress Energy. At 26%, that tells me that people think New Fortress Energy has a good chance to break out. What about Transocean? Right? Transocean, it's on like a quadruple bottom right now. Jeez. The pain. Some of these stocks won't be so actively traded. They won't have a 2026 expiration yet, but Transocean does. You could buy this thing at 402, and now they've got a strike at 4 and a strike at 5. The one at 5 is 25% above where you buy it at, just about, and they're still paying you 67 cents for it. At 4, they're paying you $1.04. $1.04 off of $4.02 is a 25.8% cash yield, but the chances of that getting called away are pretty good, because it's well, if Transocean does do the Seadrill acquisition, like a lot of people suspect they will, that could cause the price to fall. So there's a chance you could sell that call and get away with it. But I think this is much, much more likely to be called away. And I don't want my Transocean to be called away. I think if I hold it long enough, at some point in this cycle, it'll be a $25 stock. So I don't want it to get called away. But again, if you're hooked on getting 20% a year for the last couple of years, you could get a 25% cash yield on Transocean. Unless the Seadrill acquisition is really hated by the market, you know, it'll probably get called away. If you make 25% and you pay long-term capital gains on a 25.8% yield, you'll net after taxes 20% on that long-term capital gains rate. So, you know, you could turn, even if the stock market generally falls in 2025 after having two 20% up years, by selling a long-term covered call, you have pretty decent odds of having another 20% year. This $5 strike price might be more attractive, getting 67 cents on $4.02. That's still a 16.6% yield, and the chances of that getting called away are a little bit less, especially through the Seadrill acquisition. Another thing about Transocean, they just moved their corporate headquarters to Bermuda out of Switzerland, and allegedly, I don't know if this is true or not, that would facilitate the transaction, because the Swiss are a little rougher on mergers and acquisitions. So by relocating to Bermuda, it makes the Seadrill acquisition by Transocean much more likely. I have no clue if the market's going to hate this acquisition or love it, because it'll be a stock-based acquisition, because Transocean doesn't have the cash, which will dilute current shareholders of Transocean. And the acquired company always gets a favorable rate, so it's going to be, you know, the Seadrill, if this acquisition takes place, the Seadrill shareholders will get relatively more shares of Transocean than the Transocean shareholders will get more diluted. So the market might not love it, but at the same time, the income to the long-term debt, it would be a huge deleveraging event. And if anybody's predicting Transocean to go bankrupt, despite their $9 billion backlog, that would take their fears away. And then you also become the clear market size leader, and whatever premium comes with that. So I don't know if the market would hate the acquisition or love it, but this is another stock where you could lock in, in this case at $4, a 25% cash yield. I think probably pretty sure that that's going to get called away at the end of 2025, or a 16.6% cash yield, and who knows if it'll get called away next year. A lot of people are predicting 2025 to still be pretty weak for deep water offshore drilling. But at the same time, 2025, if the market's forward looking, it'll start pricing in 2026. And in 2026, there's supposed to be an increased CapEx on offshore. So, you know, it's anybody's guess for this stuff. But, so we've done New Fortress Energy, Transocean. Curious about ProFrac Holdings. That might not have a 2026 strike. Yeah, so some of these more thinly traded things, they don't go out a full year. And the reason why you want to do this around Christmas time is that full year gives you long-term capital gains that are short-term capital gains. I have it, assuming Finance of America Corp, it's the same thing. I wouldn't sell a call on my Finance of America. Oh, there we go. It actually is a full year, but it's end of December. So it's not calendar year 2026. It's calendar year 2025. There's another reason why you want the January 2026 one, which is when it gets triggered, it's going to be on your 2027 tax, April 2027 tax payment. It's not going to be in 2026. So not only is it long-term capital gains, but you have a whole nother year before you pay it. And doing December of 2025 doesn't give you that, but I'm kind of curious. So there was no volume. So these prices are not going to be accurate if no volume traded hands, because I have no idea what the stock price was in less volume. This doesn't work so well on the thinly traded stuff. Let me check out the stock that doesn't love me back, Vermillion Energy. And the chart, it's got some upward momentum finally. It's got this short-term upward momentum. It's at the bottom of the channel Some people are out there predicting there's going to be a cold winter in Europe. It has the January 2026 expiration, and for that to let your shares go at $10, you could buy at $9.55. Well, they're paying you $1.48 for that, and $1.48 out of $9.55 is a 15.5% yield. So you could lock in 15.5% cash yield by buying some Vermillion and selling the $10 strike price call for January 2026. So compared to Transocean and compared to New Fortress Energy, I'd say the gamblers that are buying lottery tickets, they're not buying this one aggressively. Now 15.5% is still means there's people out there buying this thing. They think that this lottery ticket has a chance of paying off. It just doesn't have the same chance of paying off as New Fortress Energy or as Transocean. But it's, you know, it's a lottery ticket, right? There's people out there paying good money thinking this thing might go to the moon, and that call option that they buy has a chance of really paying off well. Most options are a transfer of money from the buyer to the seller. But if you know what you're doing as a buyer, then you can have, you know, huge multi-baggers from buying these long-term options. Let's see, Vermillion Energy, Forward Air. This one's an interesting one. So I had written about this one on my Substack. I was not smart enough to sell when it was up here at 40 bucks. It's just testing the bottom of this upwards channel. And they just fired their chief operating officer. So the story with Forward Air is they did a merger, and I think the merger was fundamentally sound, but the way they did it, they had to get shareholder approval, and they didn't, so it caused a bunch of lawsuits. The CEO was fired in disgrace, and now there's a new CEO, and they're trying to digest the acquisition. And then freight generally is at the bottom of this destocking cycle. So ship logistics generally is having a tough time, but I think it's a Trump trade and it's going to come roaring back. But an activist investor is trying to push them to sell the company. So, I mean, this could sell at like a tiny little premium over the current share price, when I think this is easily a $100 stock and should be, within 2 years, should get back to being a $100 stock. But if they sell the company for $37 a share, you never get a chance to enjoy that $100. And they just fired their chief operating officer. I think the digestion of the acquisition was not going super well. Is this a bull flag? I'm not an expert on technicals, but I have a suspicion that that's a bull flag formation. I could be wrong. So it could be right to break out. This is one that I really want to let go, and I really want to rotate into something else. I'm just kind of waiting. For one thing, it's still a short-term gain for me. I bought a bunch down here at about $19. So it's still a short-term gain. I'm not super crazy about the taxes, and I also think the price should be higher. But there's so many other things that I want to buy. So does it have a long-term option? It does. And people are willing to pay. Oh, the volume is too thin. So I don't really know what people are actually paying. I mean, there was a bid at $4 for when it was open last, but that's, you know, just a tiny bit over 10%. I think it's just too thinly traded. That's a shame. Let's check out Sibanye Stillwater. That does go out. Now, sometimes, even though Sibanye Stillwater has a pretty good sized market cap, as a foreign American depository receipt, a lot of times it's not super exciting. There's not a huge volume. In this case, it does have a lot of volume. People are paying 79 cents for the right to buy Sibanye Stillwater at 5. Now, this is one of the situations where the current stock price gets caught in between bad strike prices. If there was a $4 strike price, this might have a huge premium. But still, 79 cents off of 389 is a 20% yield. Then you have to pay taxes on it. But you could get a long-term gain of a 20% yield by buying Sibanye Stillwater at 389, promising to sell it at 5. And 5 has that chance of not getting called away in 2025. It's actually Not so terrible. And if you look at the $7.50 strike price, you can get paid 36 cents. 36 cents out of 389. That's a 9.25% yield. So what are the odds Sibanye Stillwater is going to be above $7.50 before the end of January 2026? I'm a long-term bull on Sibanye Stillwater, but my understanding of the platinum and palladium market is that even if we get back into big automobile production, that there's enough stockpiles that it could take a year to burn through before the price really reacts. I have a suspicion that this $7.50 strike price, capturing 9.25% on that $7.50 strike price, that might not get called away. That might be pretty attractive. And even if it does get called away, if this is where you buy it and it gets called away at $7.50 and you add that 36 cents to it, you've doubled your money in a year. So it's hard to complain about that. Now, if you bought Sibanye Stillwater at $8 and you're sitting on this huge unrealized loss, and it finally jumped up to 20 bucks and it gets called away at 7.50, you'll be kicking yourself. You know, you're definitely not minimizing regret there. But this is a very interesting yield situation. 20% at a $5 strike price, 9.25% at a $7.50 strike price. This is pretty exciting, because if you believe that platinum and palladium are not going anywhere because, you know, hybrid vehicles are winning out in the competition over battery electric vehicles, and hybrid vehicles use more platinum and palladium than internal combustion vehicles. And platinum and palladium are mostly produced in South Africa, so there's really no way around it. And Sibanye Stillwater is selling at a huge discount, even to its peers. And it's not really in that bad a shape, because they're making money on gold, they're making money on zinc, they're making money other places. So I have a write-up on this. It's called I Love Sibanye Stillwater and Thus I Hate Myself, because it's just been so masochistic. But you could buy it here and get a 20% cash yield, long-term capital gain, promising to sell it at 5 or a 9.25%. At 9.25%, I mean, you got to go pretty far up the risk curve to get a 9.25% bond, and for that to work against you, you know, you'd have to have. If you look at the technicals, this bottom where it's at now, this is a multiple bottom. It's hit there once, twice, 3 times, 4 times, 5 times. This is at a pretty good resistance point. It did have last September, it did have that fall beneath there, but you know, buying Sibanye Stillwater at 389, that doesn't seem like an awful bet to me. I think that there are you know, way more dumb things that you can do. I can never guarantee you that it's not going to fall further, but that seems like a pretty good resistance line. The company has just so much value in assets under the ground. They have some long-term debt, but they have EBITDA to service it. Yeah, you can check out my write-up on the Substack. That's not a paywalled one, and the yield on that, it's pretty interesting. If you're not in this stock and you want to buy it at 389, clip 20% cash for 2025, and if you entered it at 389 and you sold it at 5, you wouldn't be kicking yourself. The people kicking themselves are the people that bought it at 7, and then they really don't want to sell it at 5. So if you're not in yet, this is not a bad place to enter. And if you've held it longer, I think the odds of that 750 getting called away are pretty low, because it takes time for a stock to grind that much higher. Stocks typically take the elevator up and the escalator up and the elevator down. Even on good news, I think it would be hard for Sibanye Stillwater to. I mean, I think Sibanye Stillwater will be a $20 stock at some point, but I'm thinking, you know, 3, 4, 5 years. I have a suspicion you could get away with selling that 750 call and having it not get called away from you, which is 9.25%. All right, how about Equinox Gold? This one might be too thinly traded to have. Nope, there it is, 2026. So you could buy Equinox Gold at 568. This is another one where there's a strike price problem. You could promise to sell it at 550. I think that one is almost certainly going to get called away. The 750, maybe, maybe not. Now, their Greenstone mine in Canada is almost ramped up to full production, and when they do, a lot of their accounting numbers are going to look a lot better, because while it's in the ramp-up phase, the accounting has it in this like weird temporary system. So their average all-in sustaining cost still looks terrible, and all they have to do is flip a switch to say this is not in the ramp-up phase to it's in like the fully operational phase, and then their average all-in sustaining cost is going to fall by about a third. So I think when that happens, the stock price could react. I think the $5.50, I think that's going to get called away. But if you're looking at this as compared to, well, I could buy a bond, right? So if you buy it at $5.68, you sell it at $5.50, you lose 18 cents, but you get $1.45. And so if I do $1.45 minus the 18 cents that you overpaid by, you get $1.27. That $1.27 out of $5.68, that's a 22% yield. So it's very hard to find a one-year bond with a 22% yield. Buying Equinox Gold, knowing that is going to get called away, almost certainly get called away, but you could get 22.3% in a long-term capital gain, which, by the way, you get that cash immediately, which then you can take and invest in something else. You actually get the very first term of compound interest. You get to spend that immediately. You spend it this year, so you can buy something else and have that already gaining as well. That's pretty interesting. If you are this kind of person that buys a one-year bond, it's not as safe as a one-year bond because, you know, Equinox Gold as an equity, the stock price could suffer. You know, the price of gold could crash. But China just announced that they're buying gold again. The central banks of the world, on average now, have 15% of their reserves in gold and increasing, because the United States broke rule of law, right? The rules-based order. We seized the Russian reserves, and now the rest of the world wants the money that doesn't require trust, and that's gold. So could the gold price fall? Absolutely. Could the Equinox Gold Corp stock price fall? Absolutely. I think the most likely outcome is this is like a 22% one-year bond, or you could look at the strike prices that might not get called away. The $7.50 one, they're paying you 77 cents. 77 out of 568. That's about a 13.5%. Will 750 get called away next year? Maybe. I was listening to the Market Huddle podcast, and I tend to agree with those guys a decent chunk of the time. They think that gold miners in 2025 will do very well because the price of gold probably won't fall much, and they're going to be earning so much cash that even poorly run gold miners won't be able to spend it all, and they're going to see some serious net income. So could Equinox be over 750 and you get your position called away? I think it's pretty likely. Could you take 45 cents off the table? You know, this is about an 8% yield, 7.9% yield at a $10 strike price. And that, I think, has a pretty small chance of getting called away. So this is a 22% one-year bond with, you know, some risk. This is a 13%, you know, flip of the coin whether it gets called away or not. If you buy it at 568, it gets taken away at 750, and you made 77 cents selling the option. Still a pretty darn good year. Hard to be mad at yourself, unless you want to own this thing for several years and you don't want it to get called away. And the $10 strike price, you know, pretty decent chance that in 1 year's time, the stock price can't climb that high that fast for a gold miner. I'd say low odds of this one getting called away, but you make 7.9%. Flip of the coin, this one gets called away, you make 13%. And this one is almost certain to get called away, but you make 22% long-term capital gain. Hard to be mad at that. So this is an interesting time of year. You know, do you want to sell a covered call for Christmas? You have to be a pretty greedy piggy to think, oh, 20% in a year is not enough for me. Let's look at Peabody Energy. I did put out a trade alert saying I was buying back in. I think I bought back in at 23.80 or so. And it's, you know, the stock price is still crashing. I have a suspicion that the bottom is in. Let me go to BTU. And this is it's a 1-year chart. So there should have been some resistance around this 23.80 place where I bought it. Now it's below the 200-day moving average. But below the 200-day moving average is a pretty good place to buy decent companies. I don't think the acquisition is so terrible, but the market really hates it when it's when people do anything other than share buybacks. It's at a RSI where it has a pretty good chance of bouncing off of. So I think this is a short-term bottom here. So I did a trade alert when it was right at the 200-day moving average, thinking this is a good place to bounce. Then it had a hammer candle here. I did another trade alert that a hammer candle is a great place to bounce. But Friday was just awful. I think Friday there was a lot of tax loss harvesting. Friday was that you know, NASDAQ versus the small caps, whether that's the trend or the counter trend. I feel like Peabody Energy, that this is a great place to buy. The options, if you buy it here and you sell a call at 25, they're paying $273 for that. So $273 out of $25 is about 10.9%. Not amazing, but it's also not exactly at the strike price. More exactly at the strike price, you're 38 cents over the strike price, but it's about $4. You can't get 20% off of selling a call for Peabody Energy. So in the world of thinking about the other side who's buying these lottery tickets, people are not buying that lottery ticket as aggressively. I mean, 10-11% on a strike price that's above the current market price, there's still people buying that lottery ticket. You know, that's a market. And it's not a terrible lottery ticket. It's hard to sneeze at 11% plus another $2.62 in. So if this does get called away, your total yield would be over 20% when you have the price appreciation plus the premium. But if you're thinking about only premium, it's not 20%. So people are buying this lottery ticket. It is a pretty strong market for that lottery ticket. It's a totally reasonable thing. Peabody Energy has been stuck in a channel for so long. This has been in exactly the same channel since, what is that? Since February of 2022, right? Let's go back to 3 years. That's quite a base, right? I mean, the bigger the base, the bigger the breakout. I mean, at some point, this thing has to break out of its complete sideways move. So I can see why people would want to buy that lottery ticket. If you sold that call, you know, could it by the end of 2026 have completely broken out and be a $35, $40 stock, and you'd be kicking yourself because you missed it? On a 3-year base, all of 2022, 2023, 2024, it could. I can see why people want to buy that lottery ticket. So yeah, you could get 11% cash up front, and then when you add the strike price, if it did get called away, 20%. Yeah. If you thought $35 was the target, they did have some volume trade on Friday at 69 cents. 69 cents divided by 22.38. So that's only a 3% yield. It's like a 3% cash yield, a bit like a treasury. But you have relatively small risk that the stock is really going to get called away at $35. That's one way to do covered calls, is to only do them at a strike price where if it did get called away, you wouldn't have any regrets. I mean, Carvana was really a mistake because Carvana could have gone from $4 to $80, and it did. But Peabody Energy is such a large company, and the price of coal with substitution to natural gas, you know, it could go to $30. But could Peabody Energy really, in the course of 1 year, go to $80? No, I don't think anybody believes that. That would be a little far-fetched. So if you want to clip 3% on something that's somewhat, you know, not really all that likely, that's one way to do it also. And if you clip 3% on your entire portfolio on these stock prices that, I mean, New Fortress Energy has a huge rebound to go to get back to prices it was at before. Peabody Energy, I think that's, I mean, I'm not going to call it impossible, but that might, the person who sold 4 of those options and took 3% off the table, I don't think that was so bad. I think it's very unlikely it's going to get called away. That's a long-term capital gain. I think there's pretty good odds that was just totally free money. And who's going to sneeze at free money? The chance that that is going to get called away and he's going to have to, you know, be mad at himself because he missed out on the $50 stock price, I don't think that's pretty likely. What else? A lot of these smaller companies are not going to have 2026 maturities. Portillo's does, though. Ooh. Now, I want to hold this for a long time. I'm not so eager to sell this, but one contract traded on Friday, somebody sold a $15 strike price for 95 cents, and it wouldn't have been on Friday because the volume was 0, but sometime probably last week somebody got $1.72, and the bid-ask spread was between there. Getting paid $1.72 to promise to sell your stock at $12 when you can buy it at $10.49 now, that's you know, that's over a 15% yield. I didn't crunch the numbers manual. I'll go ahead and crunch the numbers to be more exact. So $1.72 out of $10.49. Yeah, that's a 16.4% yield, cash yield, on being willing to sell your Portillos at 12. I wouldn't do that. I want to own this stock a lot longer. I think if I own this stock long enough and they are as successful in other states as they've been in Texas, because the only reason people don't like Portillo's, it's because they think it can't work outside of Chicago. But they're doing really well in Texas. And I think especially with the Hispanic population, I had a classmate years and years ago. She was half Mexican, half Polish. And the overlap between, you know, some of the flavors, using peppers, using the ingredients, I think that there's a big overlap between what Hispanics like and what Polish people like. I might be alone in this, but with the United States being like 30% Hispanic and Portillo's doing a really good everyday value thing, and Hispanic people, you know, they like American culture. They typically want to do stuff that's kind of Americana. I think Portillo's has a chance to do really well in a lot of parts of the United States, and the consensus is it's kind of stuck in just Chicago area. So I don't want to sell this call because I don't want to let the stock go. But if you were starting a new position and you just wanted to make 16% and were okay with letting it get called away at 12 and wanted that long-term capital gain for 2025, I think you could totally do it. And then, you know, is this chart, is it going to get back down to the $9 range so that, you know, it's looking pretty weak, right? You have the 200-day moving average moving down. It's been underneath that 200-day moving average for a long time. I don't know what explains this selling off. I mean, they opened new restaurants this year of, I think, 11.5%. They're opening between 12 and 15% new restaurant growth next year. I cannot explain this stock price. Could it keep going down? I mean, I suppose. I'm going to keep on buying more. It's just broken out of this upwards channel, you know, to the downside. So I cannot explain this stock price. I don't know why people hate this company. I think it's amazing, but that's what makes a market. Let's see. That's Portillo's. Heartland Express, same thing. Some of these turnarounds that could snap back so hard, I don't want to sell calls on. Heartland Express is kind of building one of these consolidating bull flags. It could go sideways for a long time. I don't know if it'll go sideways for the whole year. It does not have a 2026 expiration, which is fine. I wouldn't sell one anyway. Let's see. Look at some of my mid caps. Mid caps typically have much deeper, more liquid options markets. Newell Brands. Oof, Newell Brands was doing well yesterday. I could make $1.25. Oof, it's even higher than that. So there was no volume. The bid-ask spread was higher than the last trade. So I could make $1.35, willing to sell it at 12, or 60 cents, willing to sell it at 15. $1.25 out of 1031. So that's 12%. I think Newell Brands is going to keep on grinding higher. But if you just wanted to make, in a year where a lot of people think the S&P 500 will do 7%, and you wanted a long-term capital gain of 12%, Newell Brands, and I have a write-up on my Substack, it's not behind a paywall. They have the brands Sharpie, the Markers Expo, the dry erase markers, Rubbermaid, Mr. Coffee, the Ball branded mason jars. They have Oster blenders, I think, Osterizer. They have a lot of brands. It's a brand conglomerate, not a bland conglomerate. Consumer discretionary has been crushed, but they had a fantastic turnaround strategy. And I think this is going to be back at $25 before very long. Now, probably not within 2025. I think this is just going to grind higher for all of 2025. I don't want to sell this call, but if you were looking for, a sizable mid cap, I mean, this is a $4.45 billion market cap company, but their price to sales is almost half. This is like an $8 billion revenue company with strong brands, with defending their margins very well. So if you were looking for sort of a lower risk, right? Because if you just buy a 1-year bond, you're not going to get 12%. But if you wanted to get, a pretty darn safe 12%, I think a company like Newell Brands is very hard to beat. And then the strike price is above, so you get another $1.69 there, which if it does get called away, you get something closer to 25%. So if you want, I think, a pretty boring and safe 25% in 2025, buying Newell Brands and then selling a long-dated call for taking $1.35 cash off the table, and then if it gets called away, keeping another $1.69 in cash, you make $3 on $10.31. That's pretty hard to beat. So Charlie Munger had this thing, nobody wants to get rich slow. You can lock in a 25% long-term capital gain for 2025. You have to pay taxes on it in 2027. But that is pretty attractive. So how greedy do you have to be that 25% is not enough for you in a year? Why not just do stuff like this? Again, not financial advice, and selling options is dangerous. But there's some really creative stuff you can do with these long-term capital gain covered calls. And let me look at the other mid caps. Now, Advance Auto Parts, there was just a big cluster of insider buying, and it's really been forming this strong base around $40 a share. And it's been having a pretty good bounce. I have a suspicion that the bottom is in for Advance Auto Parts. Selling a call on this probably is not so smart, but I'm curious what people are paying for it, because that tells me how many people want to buy this lottery ticket. And they're paying $12 off of 45. So 12 out of 44.97. Yeah, they're paying 26%. This is a hot lottery ticket, right? I wrote about Advanced Auto Parts when it was closer to 60, and then the stock price fell, and then I looked like an idiot. But I think their turnaround story is solid. They got the CEO of Home Depot Logistics, and allegedly all of their problems are logistics. And if they just work on their efficiency and logistics margins, they'll be fine. And I think that market believes that story now. And this is a hot lottery ticket to buy. It's a 26% yield. But I think this would be a mistake, because I think a year from now, you're going to be much higher. So 45 plus 12 is $57. I think we're going to be higher than $57 a year from now. I think we'll get back to 60. So I think this is a bad call to sell. But what's interesting is that people are buying that lottery ticket. That's an attractive lottery ticket to buy. The bigger volume, though, people are buying this lottery ticket at 65 bucks. If you pay 6 at 65, you're not going to make money till it's over 71 by next year. So, and that's the bigger volume trade for Friday. That's interesting. So I think Advanced Auto Parts is going to work. Goodyear Tire started kind of moving away from me. It had this, let me go back to the 1 year. Yeah, so it was in this consolidating range around $8, and it crashed up to 10. It's given some back, crashed up to 11 and gave some back to 10. I mean, if the economy is going to be booming, which I think a lot of people think it will, it's at 10.16. People are paying $2.25 for the call at 10. I got to take 16 cents off there, but you can see that's a 20%, right? So if you want, if you think the bottom is in for Goodyear Tire and a year from now it won't be below 10 bucks a share, and you believe that with, you know, pretty confidently because we've been at the bottom of the logistics cycle, and that with Trump there's going to be more activity. I mean, just the accelerated depreciation and the capital spending and the increased activity is going to burn a lot of rubber. If you think it's not going to fall below 10, you can get 20% long-term capital gain, then you pay taxes on it and you're left with 15% after taxes. Or you go a little bit higher and you go to $12, you get paid $1.52, so you get paid closer to 15%, but then you get another $1.80 when it finally gets called away, and you're making over 30% next year if Goodyear Tire continues to go higher above 12. Goodyear Tire, I think their market position is in a good spot, especially with all the trade wars within the United States. I don't know how they're going to do internationally, but I think they're a better beneficiary of the cycle turning in their favor than they are of their own turnaround strategy working. I was not impressed by management's turnaround strategy, but I think the cycle itself is just going to be in their favor so much that management doesn't even have to really execute at that high of a level. Whereas, you know, Advanced Auto Parts and Newell Brands are doing the right things. And then there's Foot Locker. Foot Locker just sold off hard because the consumer was slowing down. But yeah, so they just had earnings, just sold off hard. It's at 22 bucks. And this $22 price, it's pretty low for them. Foot Locker doesn't have the same problems as Nike, where Nike is losing market share to On and Hoka. Foot Locker can sell On and Hoka. But Foot Locker has other competition. They're not the only shoe store in the mall, and malls are struggling. But with the economy heating up, again, if interest rates fall, people take some home equity out, and the economy's booming, that money circulates in the economy, I think we could be on boom times pretty soon here. I think any consumer discretionary is going to work pretty soon. I'm curious to see, though, what are people paying for this option? Because if other people think it's a good lottery ticket, that's interesting too. $22 and a $22.50 strike price. There was no volume on Friday, but there was a lot of volume on the $25 strike price. So people were paying, yeah, this price is old. The bid-ask spread was higher than that. I think it would probably be $4.90. People were paying $4.20 at the $25 strike price. $4.20 out of 22. So people were paying 19%. And that was not the closest strike price. That was at above that strike price. So yeah, the market is looking at this like a juicy lottery ticket. I'm not the only one. I'm not crazy, some hermit in a cave in the mountain that thinks that Foot Locker has real potential, because other people are buying this thing and they're paying 19% to buy that lottery ticket. So if you want 19%, you can sell that lottery ticket. But I think it's much more likely Foot Locker will bounce. But I mean, it'll be interesting to see how long it takes the money to circulate through the economy before these final end consumer goods do well. Foot Locker has that CEO who, Mary Dillon. I mean, she built Ulta Beauty into what it is today, and everything she says she's going to do with Foot Locker, I think it's the right stuff. I think it just takes time to work, and I think that the consumer has just been so crushed recently. So, you know, Mary Dillon has been an amazing CEO, and I would put some confidence in her turnaround strategy. So yeah, I like Foot Locker, and I have a write-up on my Substack. They have a hidden asset, and I wrote about that behind the paywall. So I got to try and drum up a little bit of sales and marketing for my Substack. So yeah, well, long story short, we'll go back to the S&P 500. This is not financial advice. It's not targeted financial advice, and also selling options is dangerous. But a covered call, when you own the stock and then you sell to somebody else the right to buy it, the worst thing that can happen is you sell something at a higher price than you bought it for. Well, that's not a terrible thing. The big regret comes in is if the price really moves up a lot away from you. That's a 3-year, yeah. So this is the 3-year S&P 500 chart. Having 2 years of, I think it's 25% and 27%, or 25 and 29, has been 2 incredible years in the S&P 500. And a lot of people are out there saying, well, I'm not going to get 20% again next year. Well, I just showed you a lot of ways where I think you could probably get 20% next year. The difference is the tax strategy, because if you just hold the S&P 500, you never sell anything. There's no long-term capital gains. And the strategy I'm talking about, there are some tax consequences. It's not exactly apples for apples. It's not financial advice, and options are very dangerous. But selling a long-term covered call around Christmas is a very exciting possibility if you're willing to give up the unlimited upside in order to get a 20% or a 25% upside. And how greedy do you have to be to need more than 20% every year? That's where Charlie Munger comes in with this. Nobody wants to get rich slow. And that's, one reason why, why doesn't everybody sell these things and then bring the premiums down to nothing? Well, a lot of people don't want to trigger long-term capital gains on a position they've held a long time. And a lot of people don't want to sell the unlimited potential. They don't want to sell the lottery tickets. They want to own the lottery tickets. But that's the difference between, and this gets into Benjamin Graham's security analysis, where he talked about bonds. And the defining characteristic of a bond is that it has a limited best case scenario. Well, covered calls are much more like a bond with that limited best case scenario. And those are the kinds of investments for the sophisticated investor. Because the sophisticated investor knows that that the unlimited upside, those lottery tickets, that's not the slow and steady way to compound your way to incredible wealth. That's not Charlie Munger's. Nobody wants to get rich slow, and 20 or 25% on, I think, reasonably safe bets. It's not even that slow. But that's why maybe it's worth thinking about selling a covered call for Christmas, because after a 25% years in the S&P 500, what is next year going to look like, even with the Trump euphoria? Are we going to have a 10% drawdown in 2025? Are we going to have a positive 10% year, a 15% year, a 20% year? Now, I'm not in mega caps. I'm not in the S&P 500. I'm in small caps, and some of my stuff is beaten down so much I think it could easily bounce back much more than 20%. Then again, I didn't have amazing years. I think I'd have to go back and look at the returns, but there are parts of 2023 and 2024 that were not kind to me. But the large market players that are thinking more about the mega caps in the S&P 500, a lot of them are dejected right now, saying, well, geez, what are we going to do next year after we had these enormous gains? Because the odds of another 25% year in the S&P 500, when it's already at a PE ratio so high, it's just not good odds for that. So anyway, thank you for listening. I hope you guys have a great a week looking forward. I'm going to be really curious to see, and what I'm going to be watching for again is what's trend and what's counter trend, right? Is it going to be the tech market cap weighted S&P 500? Is it going to be equal weight? Are we going to stay in our channel are we going to have a weakening dollar? Are we going to have a strengthening dollar and break out of that channel? Are we going to have a falling 10-year treasury or a rising 10-year treasury? And I think the sector rotation going into January, when people can take those gains and reallocate their portfolio, and the tax loss harvesting, I think it's going to be an interesting few weeks. I think there's going to be a lot to pay attention to. Anyway, thanks for listening. I hope you guys have a great day.